Good afternoon, everyone, and welcome to today's webinar, jointly hosted by myself, Samantha Manning at Searches UK. And today we're joined by Adam Keith and Andrew Hillier at Dualis Asset. Can I just double check if everyone can hear me clearly? If you can just let me know in the chat or the questions tab, that would be great. Just to make you aware that the webinar is being recorded live, so you will be sent a recording of the webinar after the session has ended. And if at any point during the webinar you have any questions or you would like any further information, please do let us know. There is the chat and the questions tab, so by all means, we're happy to answer any questions that you may have at the end of the webinar, where we will do a short question session. But for now, what I'll do is hand over to Adam and Andrew, but thank you all so much for attending.
Hello everyone, welcome to this presentation from us, Dualis Asset. Just to give you a bit of background to who we are, my name is Adam Keith. I'm the head of UK Commercial Legal Indemnity Underwriting at Dualis Asset. Just a bit of background, I've been in the market for 11 years after coming out of university, having studied law.
Yeah, I'm Andy Hillier. I'm one of the co-founders of Dualis Asset back in 2013 and currently the chairman of the group.
Just to give you a little background to who Dualis Asset are, as a lot of people do have questions. We were formed in 2013 and since then the team has grown to over 50 people in 5 offices across the UK and Europe. Predominantly made up of insurance professionals, property experts and qualified lawyers. We insure a range of products from the more standard conveyancing, residential and commercial legal indemnities to developments, to probate, to aviation and more recently mergers and acquisitions and share insurance. Dual Group itself is the world's largest MGA, international MGA, and we in Dualis Asset are the largest legal indemnity provider outside of North America, which is a bit of a different beast out there, as it's something that has to be taken on every sort of policy. So what I'd like to talk to you today about is what the life cycle almost of a legal indemnity policy, from the moment you first try and find someone to insure the risks, to what the policy does, what it says, and how the underwriter assesses that. And to give you some idea of what we're looking for and how we assess risk. And then we'll have a section with Andrew at the end going through claims, live claims examples and how we dealt with those. Everyone's always interested in claims because there's maybe less of them than you'd imagine, but there's also quite a few out there and they can be quite scary when they happen. So when you first discover a risk in a transaction and you decide you really would like to get some insurance to cover that, the first thing is, what do you need to tell us? So when you're coming to an insurer, the most important thing you can tell us is what's actually happening. What is the transaction? It's quite an interesting bit that gets missed out a lot of the time, and it can help solve problems. Often if a lender has picked a particular point and they just want cover for themselves and the client themselves is not particularly worried about the situation, then we can offer lender-only policies very quickly and much more cheaply, as the risk is often much reduced. If it's a refinance, that makes more sense. Basically, the reason for this is if somebody comes out of nowhere and says, we have a risk, we're not doing anything to the property, but we'd like to insure it, that sets off an alarm bell with the underwriters, because it's not often that somebody decides, you know, I should probably insure against that restrictive covenant on my title, or suddenly take out insurance against mines and minerals without something driving the need for it. You don't tend to just look through your registered title every now and then. What sort of information do we need is basically either a copy of, if you're looking at the whole transaction, a copy of the DD is always helpful, but more importantly, a note on the specific defect you're looking to insure. And when I talk through the 3 risks we're going to talk about later, I'll give you an idea of what sort of information is important in those. But generally, an outline is enough to get us started. And don't be worried about submitting risks which may be unusual or whether you don't know it can be insured. I always find probably once a week I come across a risk I never knew existed, despite having written in this market for 11 years. Particularly outside the UK, we find new risks all the time as well. The planning status and the proposed use. So I'll talk about this more on another slide, but the actual use of the property is quite important, and it really changes the risk profile. But I'll talk about that more in a minute. The value to be insured and what this represents. Now, the market as a whole in legal indemnities tends to say insure for the GDV, the actual value of the property, what's the transaction occurring, how much is it going to be worth in a development situation. The reason being that is the most you stand to lose, and it's how all our pricing models have been calibrated over the years, going back to the early years of title insurance. So everything tends to be priced on that basis. A lot of people think if they estimate the necessary level of cover based on what they think that would be, what a claim would come out as, they don't find they get much of a saving, because the underwriters know that that's not what they're actually insuring. They know they're insuring what's known as a first loss policy, and will price it accordingly. And also it does run the risk of being underinsured. Obviously, certain risks, that matters less or it matters more. If you were developing a property and you had an access issue that could prevent you from using the entire site at all, the GDV is very important. If you have a chance of repair issue, the GDV is completely immaterial, and because that works more like a fund to pay out against any claims from the church. Confirmation, no contact with potential claimants. Now, this is something that comes up quite a lot in the claim situations that we get, where often people put policies on risk and forgotten to tell us that they've actually been in contact with key parties. A lot of this time, this is generally fine because there isn't an active claim, but sometimes it can really cause issues. And also any work you've already carried out. I'll talk a bit more with restrictive covenants in particular, but I find that a lot of solicitors have done most of the hard work in the background, then send us a copy of the conveyance and the covenant they would like us to insure, and forget or don't think to tell us that they've actually checked all the neighbouring titles and they can't find anything, or that they've found one potential benefiting property, because the underwriter will do exactly the same checks as you've probably done as a solicitor, and it sort of will increase the time the underwriter unfortunately has to spend looking at that if they have to duplicate work you've already done. So continued use or development, illustrated there by an interesting small photo of a situation which is definitely an American one, not one in the UK, where development really changes the risk profile of everything that we do. When you've got something which is a risk, but it's been like that forever, generally there's very little risk there, and the premiums are much cheaper as a result. The reason being is because that if nothing changes, nobody decides that they need to kick up a fuss about it. In a lot of the claims examples you'll see, it's always because there's been some form of change to the situation around there. Nothing quite as dramatic as what we're seeing in that picture, but often that is as a telltale sign that something might come out of the woodwork. Residential is a great example of it's only when people decide to change a fence or do some work or extend out the back that all of a sudden the neighbours decide that they really care about restrictive covenants and get into fights. People who live in the same house with no changes to it for many years don't have those sort of issues. And also in things like access, you will be gaining prescriptive rights and stronger legal arguments the longer that progresses. One of the key issues for this, and the reason why development causes problems, often construction traffic. Most people don't mind an extra house and an extra car that goes up and down the road, but when that extra house requires lorry deliveries at horrible hours in the morning and extreme noise, and particularly any inconsiderate construction methods or particularly noisy builders, that can bring about a claim, because that's when people start to look into things. I can think of some of the claims back in the years that I've worked in the market, where often it's because of someone having to do something because of a development that caused a claim. One in particular, one where they cut down some trees in the back garden, and the neighbouring property, who happened to be a litigation lawyer, decided he liked those trees and he was going to look into the matter, and then took us to court on for a breach of covenant for developing. Didn't actually mind about the development, but he was very annoyed about the trees. Once you have a policy, it's actually quite important to read the policy in full and understand who your providers are and what they cover. There's a sort of misunderstanding across the market that every legal indemnity policy does the same thing, and it really doesn't. I mean, from a base level, there are exclusions that you'll have which are related to the risks, but then you'll have exclusions within the actual policy itself, which would be standard for those insurers. And it's always worth familiarising yourself with those of the insurers you use, because they do vary from insurer to insurer. We know several of our competitors, for example, put in exclusions that we wouldn't put in, which limits your cover and your ability to disclose policies or deal with potential purchasers that we find more restrictive and wouldn't look to do ourselves. There's conditions in policies as well. Often there's simple conditions that the policy will impose, like pay the premium on time, but they do often get overlooked. But there's also conditions that can be there in relation to the risk. Often in cases of things like adverse possession or similar risks, it says don't make an application to register the land without the insurer's consent. The number of people that come to us after they put in an application to say, oh, I forgot to tell you about this. It's good, brilliant. Bit late, we could probably give the consent, but thanks for that. We'll have to look at it now. And it's often fine, but sometimes it could cause an issue. If that brings about a claim, your client is in a much more precarious situation than it could have been. Very simple one, the term of the policy. The general rule across the market is risks are in perpetuity, but some aren't. I can think of a couple of examples which are generally risks that don't get better with time, such as obligations in a lease, maybe where you've got lack of mortgagee step-in rights in the event of forfeiture. That risk never gets better over the 25 years that policy is usually in place for. So it's term limited by 25 years, which is a very long time, but often some lenders can get a bit funny about that and maybe want it extended to match the length of their mortgage. The actual underlying insurer now, dual assets and MGA, which means we actually underwrite on the basis of multiple insurers. We collate their capacity and apply the right one at the right time, basically. And there are many in this market who are MGAs. There are very few direct insurers. And understanding the underlying insurer and their rating and flexibility and approach to claims is actually key to understanding whether or not you've got a good policy. We're very lucky to have Catlin as one of our providers, who are well regarded as one of the best insurance teams in the market for claims. They're very, very practical and tend to look at things and approve claims where other people might not want to. The rating can be very important. Most providers will have a track record, but if your provider has a lower rating, so it's not A or A plus rated by Standard & Poor's and Moody's, one of those similar rating agencies, you do run the risk that the policy may not pay out in the future, or at least not pay out to a significant amount. The financial ombudsman will limit its compensation to around 95k. So you'll have the issue that a lot of these policies may not be fit for purpose if they were with a poorly rated insurer who no longer exists some point in the future. Obviously, with a lot of the insurers in the market, particularly some of the ones we use, like if AXA suddenly go under, we've got bigger problems than in a couple of legal indemnity policies as a global financial industry. And then our more efficient policies available. Often you get a lot of people looking at development sites a long time in the future and paying a full premium up front for speculative planning they may not get can often be inappropriate. So it's good to look at that and see if there's any way of staggering the payments on a planning basis. We have a particular policy on that called a developer's policy, or an option policy where people are just taking options over lands. And then this is one that often gets overlooked, is the actual heads of loss of the policy itself. Every legal indemnity policy is based on diminution of value of the land. So what is the value worth before the risk occurs with no risk there, and what's it worth now the risk has crystallized? That's done usually by some sort of surveyor or valuer looking at it and making a judgment. That's fine, but if you've got a 10-year lease, the value of the land has no meaning to you whatsoever. So things like rental liability or loss of rent or business interruption or loss of profits for ongoing concerns, those sort of extra heads of loss really need to be thought about. Basic policies won't have it. And then you have the nature of legal expenses. Now, there's only a couple of providers in the market that provide legal expenses, and we're one of them, which are above the policy amount. Everything else is included in it. So with our policies, you can put in the GDV and know that if it goes to the worst case scenario and we have to pay out the full amount, we'll also pay the legal costs on top of that. Other providers will not, so you may have to build in something to your policy amount to consider whether or not you need to cover some extra legal fees in the event of a claim. And you'll see later on, a lot of the time, settlement amounts can be a lot, but legal fees can be a lot more. So how do we actually underwrite? So I'll take you through 3 examples here of cases, and I have pulled the pictures from these randomly off a mapping system that we have. So they're not related to the cases we're actually talking about for privacy concerns. If these happen to be any places you know, then that's just pure luck. So access. If you consider the picture here, the red land, which is outlined, is the problem land for us, essentially the servient land under an access. Our property somewhere to the north is using that access way. Now, what do we look for in an access case? Mostly it's how that land is used and any potential intensification. So that's why development matters. If you're currently using that as an emergency access for a pedestrian, so someone walks down there once every 4 months, there's really little problem there, and it's very unlikely to cause any issues. But if you were to develop that by sticking an extra 9 flats on top of it and making it a key main access for numerous people, particularly if it's then rented out to something like young students who might be particularly noisy in the early hours of the morning, all of a sudden you might get a real problem there. The type of access is important as well. What's it going to be used for? Is it just pedestrian or is it vehicular? Will construction traffic go over the top of it? That can be a real problem. And then actually the real key point is it registered? Unregistered land is obviously a lot easier to insure than registered land, because with registered land, you've got to talk to the owner and they know they own that land. That being said, I've had a couple of claims where the owner of the land has claimed ad medium film and caused us a claim by claiming that halfway ownership point. So even the unregistered land is less likely, but also if the development or the change of use or the continuation of use is quite small, then realistically no one's going to look to an obscure legal rule to try and deal with the situation unless they know a lot about the law and the starting point. Is it going to be used for similar uses before? So you can develop the site which had 4 cars traveling down it, but it actually now only has 3 cars traveling down it a day. That's obviously reducing the use. Your prescriptive right is probably maintained and you're less likelihood of an issue. Who maintains it? If everyone's contributing to maintenance, that's great, because everyone has an interest in keeping the access as it is and well up to standard. If no one's maintaining it and you're planning on developing and you want to upgrade it into a much better standard, that's generally good as well, because a lot of people will enjoy that. But if there's a very heavy-handed residents committee that don't like the idea of you putting flats on top of what was a single house in their nice leafy Surrey street, then you might have more of an issue. And then just generally the disruption cost, construction traffic being the worst of that. But obviously we mentioned things like students and HMOs and anything which would be classed as more of a noise nuisance in the area. So noise complaints tend to bring about most of these type of claims a lot of the time. That and people parking inconsiderately and blocking the access way. Adverse possession, more of an interesting one. Here's an example on there where there's a title which completely slips through the middle of two areas. What are the key factors we look at adverse possession? It's nearly always the registration issue. If it's registered, it's extremely hard for us to insure it because the law has changed so dramatically. That being said, if that party is potentially bona vacante or long gone from the area, as you can see, that strip of land is completely landlocked and of no use to this party. That is probably insurable in that sense, because no one will ever see it again, particularly if it's never been charged by any bank, and it'll have no one who knows about it will come forward. You'll often see in development sites, often the thickness of the pen can cause there to be gaps around the edges for house builder areas. Again, less of a concern because the house builder won't care anymore, they've moved on. What we really get into fights about is often residential garden land. When it comes down to being the issue between where a fence lies in people's gardens, you wouldn't believe the amount of money people will spend and the fights they will have in order to claim the smallest areas of land. There's several cases that went as far as the Supreme Court, which spent a ludicrous amount of money on land that was worth less than 20 grand. It's just, there's so much emotion involved in that. So often that sort of use is important. In a commercial site such as this, if that person comes forward, they're looking for a payment. They're not looking for any point of principle anymore. It's always one of the scary things in claims, I think, is if you get people that care about principles rather than just wanting a bit of money to go away. Historic documents can be important as well, because was it just missed off a title plan, for example? Was it just an issue of a thick pen, or was there a reason to leave it there? Often with access is a key one for that. Often you'll get little ransom strips that are left around. Whether or not that was deliberate or not can often be ascertained from the original development site. If it looks like they intended to include all of it and it just looks like a thick pen's left a bit, then it's generally okay. The value of that land to development is also quite key. If we were to build a new building there, right smack down in the middle of that, it'll obviously cost more for us to insure it, because if they claim it, we have to tear the building down. As where if it's just used as a bit of a landscaping or something, that has much less of a monetary value, and the premium will be accordingly very different. So that's sort of the things we look at in these sort of areas. Also, ownership and fencing of it. The best type is fully fenced in, been there for years, brick wall preferably around it, that sort of thing's lovely, but you don't actually have to show that it's fully fenced to show ownership. The fact it's in your use and only in your control and no one else can get anywhere near it is also very good evidence of possession. Exactly the same sort of things you'd use to apply to the land registry for possession in those cases. And we can, particularly where the land is unregistered, write policies that allow you to approach the land registry to register it, as long as the information behind it is sufficient. We obviously don't insure the risk the land registry says you don't have enough evidence to get possessory title, but we do insure in case somebody pops out of the woodwork and says, actually that's my land, and causes a fight over it essentially. Covenants. Restrictive covenants are probably the most common risk that we'd see day to day. They're also kind of undervalued in the market. They get insured very easily when in fact they can cause some of the bigger claims. What are the key factors in covenants? Well, age, registration. So is it pre-1925? Probably going to insure it quite easily. So post-1925 gets more tricky. If it's in a transfer, that means the land was registered at the time, which means it automatically passes. Is it D2 registered if it's not a transfer? Because that means it's someone sought to protect it. What does the wording say? Who does it benefit? These are all the things you'd think of when you think of whether a covenant is forcible. So these are the type of things that we would look at in each of these situations. In the case that we've got here, this is actually a screenshot of an area in South London called Purley, which is quite famous for its covenants. And as you can see, there are planning. The green little marks on the land and the orange and red marks are all planning permissions in the local area. Where you can see blue titles on top, those are leaseholds where it's already been split. And a lot of these covenants say single private dwelling house. So the actual restriction there is so important because it restricts the area to these single house plots. And when these people breach it, it becomes problematic. Obviously, the more breaches in the area, the less value the covenant then has in terms of someone bringing a claim against it. If you're the last house in the street to convert into flats and someone tries to bring a claim against you, they're not going to have much joy if the rest of the street is now flats, because there's no real benefit to that anymore. But, and this is the problem with covenants, they'll still be able to extract some money from us, even if it's just legal expenses. Is the development in keeping? If you take that site there, and what they're tending to doing is demolishing a bungalow and building a house which matches all the other houses in the area, that's probably very acceptable. You won't get many people complaining about that. You'll get complaints because everyone complains about planning, regardless of what it is. There'll always be someone to complain. Just the general effect of the covenant. What's it doing? What's it there to protect? And who does it affect most? If it's there to protect a certain area, like protect a view, protect something like recreational land, and the change in loss of that will affect numerous properties nearby, that's a really difficult covenant to insure, regardless of the age often. And then you've also got certain parties to covenants, which can be problematic. So you can look at certain things down on in the pool area of sandbanks in particular. There are covenants in favour of particular states which are notorious for charging high release fees, or in some cases just for the approval of plans to get something through. So we'll move now on to the claims slide. I could talk about risks all day and all the various ones. So I tried to nail the three that we see the most and probably the most misunderstood in terms of what affects them. Other ones that we have, sort of mines and minerals, is not so much as an issue unless you're developing. Then you get more rare things such as chance of repair, which I don't think anyone has had a claim on.
Great, thanks, Adam. So I'll just start off. What we're going to try and do here in the claim section is just have a look back, give you a little bit of overview of some of the claims that we've just had at dual asset since we started, and then have a look at 3 Pacific access, adverse possession, and covenant claims that we've worked through and settled. But just go back to Adam's point on the chancel repair. There was a reason he said that, actually, because I'm probably one of the few people in the country that did have a chancel repair liability, and I did get a claim against by my local parochial parish council, the church, and I did actually end up having to pay £8,000 to make a full and final settlement for it. So although rare, I didn't actually have a policy because at the time I hadn't started dual asset and I didn't know you could buy chancel policies. So when I bought the piece of land in question, but they definitely, they definitely do come out from time to time if you have a slightly aggressive local church, which I did have. Okay, so just moving on to some basic high-level stats from when we started. So just you can see the screen there. We've had about just over 178 claims to date. The slide on the right-hand side is the percentage of those claims through the various types, commercial, residential, etc. You can see that the vast majority of them are actually commercial. We've settled, of the 178, we've settled 55 to date. Some of the others have gone away, but we've got 46 live claims that we're currently dealing with. You can see that we've got reserves of something like just under £3 million for those matters, and we've paid out. The carriers have paid out nearly £3 million in claims to date, of which, going back to Adam's point earlier on about legal and professional fees, nearly £1 million of that is actually legal and professional fees in terms of what we've paid to date. I think the overall attitude that we have to claims at dual asset and have had since the beginning when we started was we try and take a commercial approach to claims. We know that the claims are not as, we don't get as many claims as in other types of insurance products, and so when we do get them, we know that we try and work through with the insured to try and find a solution for them. Interestingly, probably for you guys, one of the things that we also do at dual asset is we don't insist the insured uses one of our panel solicitors. We believe very much if the insured solicitor wants to carry on with dealing with the claim, bearing in mind that as Adam said earlier, the policy mustn't be disclosed to the claimant, so the insured needs to be acting as if they were going it alone, albeit talking to us in the background. But we feel that it's really important, actually, the insured solicitor is the one that's got the background on the deal. They probably bought the property for the insured at the beginning. If it's a commercial claim, then they're probably the ones that are dealing with the the development or the ongoing work that is going on the site. And so we believe that as long as the solicitor wants to carry on with that position, we do have some where they don't, which is fine. We can appoint our own lawyers for the insured. But generally speaking, we really like to use the insured's lawyers for continuity in terms of that. I think the last sort of high level thing I'd just say is that you can see on this slide that average settlement time for us to settle a claim is 9 months. We appreciate when a claim comes in, it's an anxious time probably for the insured, even though they know they've got a policy. They might be wanting to carry on with a development, by building extension on the house, whatever, and all those sort of things within the scope of the policy. we do try and take into consideration so as not to delay the time that we can reach a settlement on it. And I think the last thing I was just going to say, again, something that really important that the claims team see dual asset, which Adam again touched on, was the presentation of risks. And he talked very much there about presentation of risks when they come into the underwriters in dual asset. But I'd just like to touch for those of you who have or haven't yet, if you want to use our online comparison site, the My Legal Indemnity shop. And there again, it's really important on presenting the facts, which in that instance is online through the statement of facts boxes that need to be ticked. Those are ticked accurately. Probably of the claims that we have to decline, it's coming through the MLIS site because the statement of facts, just are not ticked incorrectly. And so we really encourage people, to go online, use the MLIS site. But any doubts you have over a statement of fact, just don't tick it, and it throws it out as a referral to our underwriting team. So presentation of facts as Adam said earlier on, really, really important in terms of getting through the policy. So let's have a look at a couple of examples of the types of underwriting that Adam took us through earlier on. First one he talked about was an access claim. So a little summary of an access claim here that we settled last year. So just taking through the sort of chronological facts of where we were with it. And this is a slightly different twist on this one, which you'll see actually in the next part of it, because sometimes the claims don't always go in exactly the same direction that the claims team are expecting them to do so. Where it's this was an access way where somebody was claiming that they, as in Adam's example, someone was claiming that they had the possession of to stop the development that was taking place. We very often, again, using the insured's lawyers or indeed outside counsel from our people that we've worked with previously, we very often will seek a counsel's opinion at the beginning, very early on, so that we can get a handle on where we believe that we could go. In this case, as probably many of you have come across, the claimant was a non-trading company, little cash at hand. So when we initially went back to them, we talked to them, if you're going to litigate, don't forget we'll go for security of costs, which just makes any claimant just think a little bit more about the way that they're going to handle something. You can see there on the side that the counsel's opinion came back reasonably strongly for us, in that they thought we got the prescriptive rights existed. Again, going back to Adam's example he talked you through earlier on, counsel's opinion was that the change of use was unlikely to result in an excessive use, which is one of the things that both the underwriters look at very strongly, and then we have to look at, the claims team have to look at when that comes in. You can see then that the claimant, after initial flurry of correspondence, the claimant was asking for £150,000. Based on the opinion that we'd had from the counsel, our advice to the insured's lawyers was to basically robustly defend the claim, because we thought that the claimant would go away. Now, in this instance, there was a bit of a twist to it, because in March 2019, the insurer's lawyers actually came back to us and said that they had agreed to pay the claimant £80,000 for the transfer of the access. Now, they did that because they wanted to get on and get it settled, not because we didn't believe it was something that was going to get sorted out at the end of the day. But they went off and made that settlement on their own without consulting us. However, they did come back and ask us about the legal fees for both the claimant and their own, and we agreed to settle those. And you can see in the little bright box, little bright circle at the bottom there, that we ended up paying just under £17,000 of legal fees, and we settled that claim within 11 weeks. So a little bit of an odd one in that the insurer just decided to go off and do their own thing, but a lot of similarities with the type of case that Adam took you through on access earlier. So if we move on now to the second one that we talked about, which was the adverse possession claim. This was a very interesting one. So this was in the Midlands. It was actually a retail park, and we had insured a piece of registered land for adverse possession that went through a development site. Whereas I said they're looking at developing a retail park. They got quite a bit of the way down the line in terms of the development, and then lo and behold, somebody writes to the developer, our insured, and says, "Oh, by the way, we own the strip of land through the middle of the site," which was a bit scary to begin with, because it was quite a bit of it was quite a large retail site. Probably we could have it wasn't too late to have got the insureds maybe to have changed around the layout of their retail park so that actually one of the retail units wasn't going over the adversely possessed land, and maybe the car park could have been there, but it would have all been a little bit it would have been a bit messy. We did quite a lot of research on the claimant. It looked as if they were a normal individual who probably owned an old warehouse on the site, and when he sold the old warehouse, he kept a strip of land, presumably because he thought if there was a development on the site in the future, he might get some money out of it. And then he just moved out to the area, and nobody heard of him until he brought the claim. However, going back to some of the things that Adam talked to you about, when the underwriters look at things, it was really clear. It was really clear from the beginning that this guy didn't want to hold up the development, but he was actually just after some cash to basically go away, which is what we find on most of these claims at the end of the day. Adam says, the ones where people are going to dig in on principle over something are obviously the ones that are the most contentious for us to try and get resolved. But luckily we don't find very many of those coming up with that. So in this instance, there was a bit of toing and froing between ourselves, or the insured, and the claimant. But in the end, we agreed to pay £90,000 to the claimant, which included their costs, and there were some costs on top of that for the insured's lawyers. So we ended up paying out just under 100,000. But I think on this one, because it's a development one, going back to some of the things we talked about at the beginning, you can see there we settled this claim, which could have been quite contentious. We settled it within 8 weeks. And going, talking about the stuff I talked about at the beginning, the high overview of things, this is a developer on site wanting to get on with their development. We could have spent ages toing and froing with the claimant, but we took the view that we wanted to get it settled, within something that we felt was reasonable, instead of hanging out for weeks and weeks trying to negotiate it going down. So I think for me on this one, the fact that we got it settled in 8 weeks is probably the most important thing, other than the amount of money that we had to pay to the claimant. So that was the adverse possession claim. And then the final one that Adam talked you through was a restrictive covenant claim. So this is not necessarily the most common restrictive covenant claim that we see, but actually touching on what Adam said, this is one where actually somebody was redeveloping a building to become a hotel, and there was a covenant from a local landed estate on it, which basically said that they had to approve the development plans before it could start, but it said they shouldn't be unreasonably withheld. Now, we wrote to the claimant, or the insured wrote to the claimant, asking them to clarify as to how they thought they benefited from the covenant, etc., etc. and we had a funny response, which was basically, because it was obviously something that they'd done all over the area, wrote back and said, we would grant approval, but our usual rate is £5,000 per unit, in this case £5,000 per hotel bedroom. So this was obviously something that was fairly standard for these guys to do. We sort of ummed and ahed about it with the insured. The insured was cracking on with the development, but obviously in order for them to get the hotel opened, they were going to need to settle with the covenant holders. The covenants were enforceable. We did take council's opinion on it. Covenants were enforceable, but because of the not unreasonably withheld piece, there was probably mitigating factors around it. But we decided that we would try and make a settlement within a reasonable time frame on it. So we made an offer of £60,000 plus costs. The claimant countered with 150. It was quite clear that they'd done this around the area previously and picked up money from other developers. So in the end, we agreed to their offer, and we settled at the 150,000. Because we'd had a bit of toing and froing on it, the legal costs again were quite high on the insured side. On the claimant's fees, they weren't. They were only about £6,000. So in all, on that particular restrictive covenant claim, we ended up paying about 175,000, and we wrapped that one up in a 6-month period. So there we are. So that's the overview of 3 situations that we find ourselves in, and the way that dual asset looks at underwriting those types of risks, and the way that our claims team responds to them when and if they come in as claims. Hope you found that interesting.
Yeah, see if there's any questions at all. Access to that.
Chat.
Yeah, can't see anything in there.
Sometimes people are.
See any, unfortunately, so it doesn't look like we have any written down, but if you do have any questions, our details are on screen. You can get in touch with us. We do like talking about these, or in fact anyone in our team. We do enjoy talking a lot about these type of risks, so we're quite boring in that sense.
Hope you found it all interesting. As Adam says, please do send any queries you have in to us if you want to have a further chat about anything.
Perfect, brilliant. Well, thank you so much, Adam and Andrew, for hosting today's webinar. As they've both said, we do actually have a question that's just come in, Adam, if that's okay. Do you have some time, both of you? Yeah, perfect, brilliant. So our question is, we are looking to buy a plot with a deficiency on the vehicular access. Plot is currently undeveloped land worth £100,000. My client wants to build, but possibly not for a few years. Property with house would then be approximately 350,000. Current sellers have provided a policy, but restricted to current use, i.e. undeveloped land. Could you provide policy for future developed use?
Yeah, depending on the factor around why the access is deficient. I don't know why anyone thinks a continued use policy would help there, really. It does. I mean, yeah, continue to access your undeveloped land, really great. Yeah, it seems very, very straightforward in that sense, as long as there's not some like horrible big gate at the front of it that means they can't get anywhere near it. Yeah, I mean, one house on top of a normal plot of land isn't much of an increase in use of that accessway anyway. It's only one person going to and from, slightly more hours, obviously. So, yeah, it's definitely something we'd look at.
Brilliant. Okay, and we've just had another question, and one of our attendees has asked, what is the largest claim that you have ever paid on?
The largest claim that we've paid on has been nearly £2 million.
Oh, okay.
Yeah.
Very big claim. Okay.
Yeah. As well, so.
And just another question has come in, and it says, why do a disproportionately high number of claims appear to emanate from Scotland?
Very good question, actually. It's quite funny. We have looked at where the claims do tend to congregate, and very strangely as well, it's usually the Highlands. A lot of it's to do with renewables, actually. Wind turbines and things like that going up in that. Well, you wouldn't put much solar power in the Highlands, to be fair. You put any wind turbines up there, you've got lots of issues with accesses, with ownership rights, with things like crofting and various other Scottish specific ones. Mines and minerals is quite a big claimant one in Scotland. And also the law in Scotland can be, it's a lot stricter up there. There's no real concept of equity really that we have here in England and Wales and Northern Ireland to an extent. So they tend to be very much more like clean, and people seem to know what they're talking about a lot more on these. I think you just run into a lot of very landed gentry up there that own very big estates that tend to want a bit of money. So.
Okay, brilliant. Thank you.
Just to clarify, in case people think that my maths is really bad, the statistics that we did was for this webinar, which was the UK and Scotland. Obviously, we're a global insurer, and so some of our claims are a lot higher than that. But the stats were just for the UK and Europe. The claim I was referring to was actually a European claim.
Okay, brilliant. Thank you so much for saying, Andrew. So we've got no more questions at the moment. What we will do is if anyone does have any questions, obviously Adam and Andrew's contact details are on the screen at the moment. You can contact us at Searches UK. So our email address is marketing@searchesuk.co.uk. You can also give myself a call. My telephone number is 01273 764 920, and I'll be happy to answer any questions you may have. But I thank you all so much for joining. I hope you enjoyed the webinar, and we'll see you again soon. Take care. Bye.
Thanks very much. Bye.